evening, ladies and gentlemen. It's a great pleasure to be here once again to speak to you. Allianz Global Investors is not related to Allianz Trust, so very different. I am the portfolio manager of the Merchants Trust, and I'm the Chief Investment Officer for UK equities at Allianz Global Investors. I get confused myself. What I'd like to talk to you today about is very often portfolio managers come up, and I've done it myself, and we talk about what we look for in a company, and we talk about why we bought a company. We sometimes talk about why we sell a company. What we don't talk about very often is when should you buy the company? What do you do if you buy the company and the share price starts going down? How should you manage the position size in the company? So today's presentation, which is called Falling Knives and Boiling Frogs, tries to look at that. I'm actually going to break the presentation in two parts. I'm going to spend hopefully about 10 minutes talking about the first bit. And the second bit, I'll talk about the Merchants Trust, which I manage, and 130 years old, but again, a relative newcomer again, as we've just been discussing tonight. So in terms of some portfolio management questions, I think, interestingly enough, I saw Russ speaking at an event very recently, and he said one of the things that he looks for in portfolio managers is an element of humility and a knowledge of fallibility, that we are fallible. Now, I'm not going to sure about humility, but certainly there's plenty of examples in this presentation tonight of where we have been fallible, where we are fallible, and some of the mistakes we may have made. But hopefully by talking about that, we can also learn something about what you can do in a portfolio. So I'm going to look at a few questions that we sometimes get. Should you catch a falling knife? Often investors say, never catch a falling knife, which is a share that's falling very fast, feeling if you catch it, you might cut your hand off in the process. Should you have a stop-loss policy? I'll come back to that. My friends, the boiling frogs, I'll come back to them. They're the things I really worry about. And then finally, how do you measure the position size in the portfolio, or how do you manage the position size in a portfolio? So I'm going to start with the falling knives. So these are two companies in the same sector, and I'm not going to name them, and have a think about them if you like, and we can talk about it afterwards over a drink. But two companies in the same sector that have been falling very fast this year, and by sort of the end of July, early August, one of them had fallen about 40%, and one of them had fallen about 60%. And some people would say, well, these are falling knives, you should stay well away, you don't want to buy these companies. We actually owned the red one throughout that period. And we took a decision in August to buy some more of the red one. And we felt that the red one was being driven down by what was happening, particularly at the green one. But it's in a difficult industry. It's got challenges, clearly. But the shares were very cheap even at the beginning of the year and got cheaper and cheaper. Now, what happened in the rest of the year is actually the red share rebounded to the point where it's almost back at where it was at the beginning of the year, whereas the green company continued to go sideways broadly and hasn't really recovered since. And what the key difference here was that the companies had very different balance sheet structure. So the company in red, although it was in the same industry as the other one, had a much stronger balance sheet, and also it had very diversified assets. It had the ability to sell assets and realize value, and it's actually done some of that, which takes even more strain off the balance sheet and relieves the pressure. Some of its assets are still worth a very high price, even if there's a question mark over some of the others. So two companies in the very same sector can be very different. And what's interesting about this, you may have just said, look, just don't own these things, just focus on quality growth companies and you'll be fine. But if you'd bought the red company in sort of July, August, you could have made 50% by now. So that you can sometimes make very good returns by focusing on real value at a time when it's out of favor. And I think the key thing as an investor to ask yourself is if you're in one of these situations and you're thinking about adding to it or selling it, why did you buy it? What was the investment case? And what's changed? Has anything changed at the company? Is it doing things differently? Has anything changed in the industry? Is there a new competitor coming along which is challenging it, or new technology which is compromising it? And you've got to be very open and very honest about this. And we find it helpful to write down initially why we buy a company and record it and go back and look at that again. Is the macroeconomic environment different? Are financial markets different? Clearly, with interest rates at sort of 1 or 2%, as they are in the UK, in terms of long bond yields, it's very different to if interest rates and bond yields are 9 or 10%. And that can make a big difference to the valuation. And failing all that, ask yourself, why have the shares been weak? if you really don't know why the shares have been so weak, that's actually, to me, that's quite a warning sign. I like to understand why other investors are still selling the shares. And if I can understand that, at least I can rationalize whether I think it's sensible or not. So I find it very helpful if I can't understand why the shares have been really weak, I think I'm missing something maybe. So try and do that. And then finally, of course, the balance sheet. Balance sheet's absolutely critical in every company, but particularly when you're looking at buying companies that have been under pressure, where the share prices have fallen aggressively. You can lose a lot of money if you've got a company that's in a difficult industry and the balance sheet is stretched. Whereas if the balance sheet is okay, very often companies can have time to restructure themselves and turn themselves around. So that's the first question. The second one is should you have a stop-loss policy? A stop-loss policy effectively is where you say you will sell a share if the share price drops by a certain amount after you've bought it. It might be 10%, it might be 20%. And it might seem quite sensible to prevent a big loss. If a share price goes down 10% after you've bought it, you can avoid the next 50% if you got it wrong. The flip side, of course, is you could miss out on an even bigger recovery if you sell it at the wrong time. So is it right or not? I read a book a long time ago called Market Wizards, which interviewed a lot of very successful traders, and some of them absolutely swore by a stop-loss policy, whereas others didn't use one at all, or actually thought they were very harmful to their approach. To me, they make most sense if you have a momentum type strategy. If your strategy is to buy companies that are performing well, the business is seeing upgrades to their earnings expectations, the shares are rising, and you have a momentum policy. And many investors have an explicit momentum policy in their strategy. They like to buy companies where the share price is outperforming. And there are statistical reasons for that, at least in the short term, although long term, interestingly, positive momentum tends to reverse. But in the short term, it tends to go on. So if you have a momentum strategy, it absolutely might make sense that if something's not right, if it's not working, get out. If, however, you have a value strategy like we do, and you're buying companies because they're getting cheaper, it may not make sense, and we certainly don't have a stop-loss policy, but it may not make sense for a value strategy to think, well, okay, the shares have gone down since I bought it, let's sell it. To me, that doesn't necessarily make sense as a value investor, but it can make sense for other strategies. Which then brings me on to my fear, the boiling frog. And there's this saying that if you drop a frog in a bowl of water and then you gradually warm the water up, the frog will... Sorry, if you drop a frog in a bowl of boiling water, it will jump out to save itself because it realizes it's hot. If you drop it into a cold bowl of water and boil it up gradually, the frog won't realize it's getting warm and will gradually boil and die. And this, to me, is what you've got to watch out in investments. It's companies which actually, at the time you buy them, feel all right, has a little profit warning, something goes wrong, but actually you re-justify it. You say, well, actually, okay, that has happened, but the shares are a bit cheaper now, and it still makes sense. And then there's another issue and another warning and another issue. And over time, you've lost an awful lot of money, and worse than that, your initial investment case has been completely invalidated. Now, these can look like falling knives. In fact, the difference is quite subtle sometimes. But we try and you've got to understand what is the investment case, what has been going on. So, to give you an example from our own portfolios and to take Russ's, to prove fallibility, Centrica is a company we've owned for a long time, and we were buying quite a lot of it in 2014, 2015. And Centrica, which is now it owns the British gas franchise, which is one of the biggest energy suppliers, gas and electricity. And for several years, that's been a challenge business. Now, we bought in thinking this is one of the biggest players in the market. There should be a huge scale advantage. If you're the biggest player or one of the biggest players, your computer system can handle 5 million people instead of 1 million people for a competitor, but it doesn't cost 5 times as much. It should be much more efficient to go around to a lot of customers and knock on the doors and read the meters than having fewer customers. And they have a massive balance sheet, so they can contract with Shell and other suppliers of gas and energy to buy cheaply and to use their balance sheet to protect their customers. So theoretically, there should be a massive barrier. There should be a massive economy to scale and an advantage. But one by one, these advantages seem to get whittled away. Firstly, we had comparison websites coming up, making it much easier to see the price of different energy from different competitors. The government and the regulators were encouraging people to switch. But even that, if you've got a competitive advantage, yes, transparency is difficult, makes it difficult, but you should still survive. But then you had green costs, energy costs, which were being put on the industry, but the smaller competitors didn't have to pay these green costs. They could offer cheaper energy. They could undercut you. So the smaller players had a pricing advantage over the bigger players, which is unusual. And then to cap it all, and I really mean cap it all, you had price caps come in, even from a Conservative government, which made that it's really hard to charge different amounts and made it the price comparisons even harder. So ultimately, and the other thing is, there was no advantage to having a strong balance sheet, because if you or I, as an energy customer, found that our supply went bust, we would be protected in the scheme, and somebody else would take up that. And many of these suppliers have gone bust, a huge number of them, but the customers have all been protected. So the fact that the big companies have got a strong balance sheet has not protected them. So eventually, and we were very slow, we eventually realized in 2017 that structurally this business was not as good as we thought it should be, and we had bought a boiling frog. This frog had boiled, and so we got out. And subsequently, thankfully, from our perspective, I suppose, the shares have continued to go sideways, and then actually they fell a lot more, and they've almost halved and cut the dividend since we sold them. So we did get there eventually, but I'm just being honest. We do sometimes find these boiling frogs ourselves, and we try to avoid them if we can. So finally, in terms of this section, how do we manage a position size? Well, this is an interesting one. This is Tate & Lyle. Share price relative to the stock market. So it started at 100. After 5 years, it's broadly where it started. But in the meantime, it's been a really volatile company. It's been up and down quite a lot. And we built, the blue line at the bottom is the position we bought in terms of number of shares. So we bought a position in 2014, and we continued to add to it when the shares were quite weak in 2015, 2016. We had a good idea of what we thought the company was worth. Shares subsequently rose quite significantly. We sold some of the holding in 2017 at quite a high level. Shares came right the way back, and we started to buy them again, built up a big position. And then more recently, late last year and early this year, we've been, again, selling some of the shares and taking profits. The message here is actually, although the first purchase of the share wasn't particularly well timed, it wasn't a great decision to buy Tate & Lyle 5 years ago and hold it to today, we've still made good money for our shareholders by managing that position, taking advantage when it was really cheap, and buying a bigger position when we got more confidence and more conviction, and reducing it when there was less conviction. Clearly, to do that, you have to have a pretty good view of what you think the shares are worth, which is obviously a matter of judgment and approach and process. But you can still make a lot of money in a position if you have confidence of where you think the shares are really the right value. So if I now move on to the Merchants Trust, Merchants Trust invest totally in the UK, so different to the previous speakers. It's 100% UK equities, and we think the UK is a great place to be, actually, because you've got some of the best standards of corporate governance in the world, and yet companies in the UK actually have exposure all over the world. The top 100 have about 80% of their sales globally, and even the all-share index has about 70% of its sales coming from abroad. So you get exposure to industries around the world, even from a UK base with very strong governance standards. I've shown a picture of my colleague Matthew Tillett here, who works very closely with me, and I've shown that partly because he works very closely with me and he's a very bright guy, and partly because his parents are in the audience. And so good evening. And Merchants Trust, we have a dividend yield of 5.5%, one of the highest yields in the sector and considerably above the yield on the all-share index. And that dividend, like some of the other investment trusts tonight, has grown every year, been grown every year for 37 years. We have significant reserves. We have a strong performance record based on active portfolio management. We run a fairly concentrated fund, about 43 holdings today, and it's a value-driven approach. We try to identify companies trading below their fair value, take advantage of that, and we have a modest management fee, 0.35% of gross assets or 0.58% ongoing charges, an experienced board of investment people and also commercial people. The dividend record, well, you can see it here. We've grown the dividend for 37 years. We've used one of the great features of investment trusts is you can tuck away money in the good years when the earnings are above the dividend. You can tuck away money into reserves, and you can draw on those reserves in the tougher years post the financial crisis to keep the dividend growing. I won't say too much about it tonight, but that's a great feature of investment trusts, and we still have significant reserves, about a year's dividend in reserves, to continue to do that should we need to in a more tough environment. So what do we look for in a stock? How do we try and avoid the boiling frogs? Well, we look for three things. First thing we say is, how good a company is it? We look at the fundamentals of the business. How attractive is that industry? How strong is the company's competitive position? What are their trademarks they've got? What processes, technology? How strong is the balance sheet, this financial position? How much cash do they generate? And to follow up the previous speaker, what are the economic risks? What are the social risks? What are the environmental risks in this company? What are the governance risks? How are the management incentivized? I spend a huge amount of my time meeting the chairman of companies, trying to understand the way they think about these types of issues and how the management are remunerated as well. So how good is the business? How cheap is the business? We look at the valuation of this company compared to its history. We look at it compared to other companies we can invest in the sector, and we look at it compared to other companies across the whole market. We look for companies with a decent starting dividend yield, but that is not the reason for buying it. That's just something we look for when running a high income portfolio. Historically, high yielding shares have, on average, given a better return, which is a great place to be. But the yield is not the reason for buying a share. That's quite a dangerous thing to focus on. And then the third thing, which is to identify the boiling frogs, is what's going to change? What are the structural pressures on this industry or cyclical issues which are going to determine the long-term future? You might have a company that looks good and looks very cheap, but if there's a structural pressure, if the internet is destroying its business model, you've got to be aware of that and take that into account. Equally, if you can benefit from that, that's a very positive thing. So we try and put these three things together: buy good businesses, sound businesses on low valuations, but with a supportive thematic or macroeconomic or structural environment. And we'll still sell a stock if the investment case changes or if the valuation reaches our target. Give you one example, DFS, the UK's leading furniture retailer. Apologies if you can't read all of this at the back, but essentially DFS has about 35%, 34% of the UK sofa market. It's grown that from 9% about 25 years ago, and it has recently bought Sofology, which gives it another 9%. It has a massive scale advantage over its nearest competitor, SCS, which allows it to make much higher returns, much higher profits than most of its competitors. So it's a strong business. It's got 4 brands, which you can see on there: DFS Dwell, Sofa Workshop, Sofology. It has a big scale advantage and has negative working capital and has a high element of variable costs, so it can flex its cost base quite a lot. That's the business. It's very cheap. I won't go into that, but it's got a double-digit free cash flow yield. It generates over 10% of its market cap every year in free cash. But what's interesting is thematically, you say, well, retailers is a very difficult place to be. And it is. The internet is shaking up retail. It's making it more difficult. But people like to feel and touch and sit on their sofa before they buy it. 90% of people or so will do that. But even if you don't want to sit on it, even if you're prepared to go online and buy a sofa, it's actually very hard because sofas are individually built to order almost. You have to offer a wide range of sofas is very hard without scale, because obviously people don't just want to buy grey. And if you Amazon sofa, which I did today, you see about half a dozen very grey-looking sofas. If you want anything other than grey and anything other than standard size, you need to find someone who's got a big range and a flexible manufacturing base. But even beyond that, when someone delivers your sofa, they need 2 people, usually 2 men, and that's quite a complicated distribution network. You can't just stick it in the post. And often they'll take away the old sofa as well and recycle it, or make sure it goes to, gets disposed of in the right way. So it's a very difficult market for internet penetration, which is one of the reasons why that's quite low. There's also growth opportunities from consolidating this market. There's also recovery potential, because this is the furnishings market in the UK. It's been pretty flat since the financial crisis. It hasn't been much of a recovery. So we quite like DFS, and I'm running low on time, so I'm going to move on. But I can talk about that again afterwards if you like. A couple of things about the UK. You've heard a bit about this. The UK is one of the cheaper markets in the world. This is comparing the price to the 10-year average earnings in the UK. But more importantly than this, and we certainly heard this tonight, is the valuation of value stocks is at a huge discount to growth stocks. We're about where we were in the early 80s recession in terms of the gap between value and growth stocks. If you buy a company that's lowly valued, you can get a great bargain today in the UK. And we know the reasons. People are worried about Brexit, they're worried about trade wars, they're worried about recession. And that's meant that many British companies are trading at really quite distressed levels, or very, very low levels, whereas investors are crowding into the high-quality growth companies, which are on very high levels. We don't see much value in those areas, but we see a lot of opportunities. It's just some of the areas, some of the themes we're exploiting. If we can get exposure to emerging markets at sensible prices, there are companies like Prudential, Inchcape, PZ Cussons that are really interesting. If we can get companies that are beneficiaries of digitalization and new technology on a sensible price, that's great. And if we can buy UK companies that are really global businesses, I mean, one in the middle here, Keller. The UK is out of favour. Construction is particularly out of favour as a sector in the UK. Keller only makes 5% of its sales in the UK, but it's a world leader in ground engineering technology, piling to you and me. But they're a world leader, but they happen to be in the UK construction sector, which is deeply out of favour. That's a really interesting company in terms of a low valuation. So with my last minute, by building up a portfolio of these companies, over the last 10 years, we've delivered a very strong return compared to the all-share index. Now, there is gearing in the trust. There is borrowing, which has amplified the return. If you just looked at the portfolio level, our performance is about 1.5% per annum above the benchmark up until the end of October. And that's despite having a value focus and a value style at a time when value investing has been quite difficult. So despite that, we performed pretty well. And we're very pleased and proud of that long-term record. And so I'll just round up by just reminding you, we have a dividend yield of 5.5%. We've grown the dividend every year. That dividend growth is an absolutely critical objective of the directors. And we've grown the dividend by almost 5% last year. And the directors have said they intend to grow it over 4% this year. And I will stop at that point and say thank you very much. And please take questions.